Ja, jetzt? Ah, Start. Hat's angefangen? Kann ich? Okay. Schönen guten Tag heute zu unserer zweiten Private Equity Webinarreihe. Heute behandeln wir hauptsächlich das Thema, was die Vorteile von Private Equity Backed Unternehmen gegenüber von Public Corporations sind. Und bevor wir mit dem heutigen Vortrag anfangen, würde ich gerne das heutige Team vorstellen wollen. Wir haben Katrina und Max als Moderatoren. Der Simon wird während des Vortrages eure Fragen probieren zu beantworten im Chat und auch Fragen an mich weiterleiten gegebenenfalls. Und ich selber, Hasan Basriakmo, bin der heutige Redner. Vielleicht ein kurzes Wort zu mir, bevor dann Katrina noch ein paar organisatorische Sachen nennt. Ich selber habe einen Bachelor of Science in International Economics an der Eberhard-Karls-Universität Tübingen abgeschlossen, studiere derzeit meinen Master in Management and Technology an der Technischen Universität München. Meine Private Equity Erfahrung kennzeichnet sich dadurch, dass ich knapp ein Jahr als Analyst bei einem MedTech Private Equity Unternehmen gearbeitet habe. Anschließend ein Praktikum in Investment Banking in der M&A Abteilung von Oaklands Angermann AG. Anschließend darauf dann Research-Tätigkeiten, genau für den Lehrstuhl für Entrepreneurial Finance, wo eben Private Equity und Venture Capital dann auch dazugehört. Und jetzt seit Februar bin ich bei BCG, der Boston Consulting Group, Bereich Principal Investors und Private Equity tätig, wo dann auch meine Kernkompetenzen genau in diesem Feld liegen. Das wäre es erstmal soweit zu meiner Person. Und jetzt würde euch Katrina noch ein paar nähere Infos zur Struktur geben. Ach, ähm, okay, das ist jetzt ein bisschen schwierig. Vielleicht kannst du auf laut machen, dann hört man die Katrina, wenn du auf dein... Achso, das ist jetzt auch nicht möglich. Ansonsten kann ich ja vielleicht die Quick Facts einfach mal durchgeben. Könntest du mir noch mal kurz nennen, Katrina, die wichtigsten Sachen vorweg? Am Ende finden wir dann bestimmt noch eine Möglichkeit. Mhm. Mhm. Ja, also wegen technischen Problemen konntet ihr gerade Katrina kurz nicht hören, aber grundlegend solltet ihr über den Vortrag wissen, dass es am Ende eine Prüfung gibt, die dann über Moodle laufen wird und die könnt ihr euch im CFS Silber anrechnen lassen. Also es lohnt sich auf jeden Fall zuzuhören und sich auch die ein oder anderen Notizen zu machen. Am Ende der Vortragsreihe werde ich nochmal paar Zusammenfassungsfolien erstellen, damit auch das Lernen für euch etwas übersichtlicher ist, weil es diesmal eben keine One-Pager zu den Vorträgen gibt, würde ich da einfach am Ende nochmal eine kurze Zusammenfassung mit den wichtigsten Folien euch präsentieren. Aber ja, das wäre es dann auch soweit von der organisatorischen Seite. Dann würde ich sagen, fangen wir einfach mal mit dem Vortrag an. Der Vortrag würde auch wie letztes Mal auf Englisch ablaufen. Wenn ihr Fragen habt, könnt ihr die gerne auf Deutsch oder auf Englisch stellen. Wir werden sie entsprechend entgegennehmen. Okay, so let's come to the structure for this day's presentation. Last time we had the first three topics covered. We had the definition of private equity, we talked about different forms of private equity investing, and about the conceptual foundations of buyouts. And this time we have the topics public corporations versus private equity companies. What are the differences? What are the advantages among each other? Afterwards we will talk about private equity firms as financial intermediaries. why private equity firms are relevant as financial intermediaries and why their presence is legitimate. And the last point for today is going to be fund lifecycle and fundraising. There we will have a deep dive into how fundraising process is generally designed and what's going on within the fundraising process. For the next week, we will talk about fee components. In private equity, we will also talk about different performance measurement and distribution possibilities of fund returns. And we will also analyze the observed performance of private equity funds, which is quite interesting to have a feeling for the returns that are generated of the industry, also compared to other peers such as asset management or something else. Okay, let's come to the first point of today, comparison of public and private corporations. Well, we will mainly talk about the paper Eclipse of the Public Corporation because it is a quite old paper. It has been written in beginning of 1990s, where Michael Jensen, which is a quite popular author, had a scientific paper how LBOs created substantial value during its time. Jensen observes that there are more and more leveraged buyouts in the 1980s in the US, and that these seem to create substantial wealth for shareholders. And he analyzes this. He finds that there is a principal-agent conflict which affects the use of free cash flows of public corporates. He identifies the conflict between owners and managers over the control or use of corporate resources and the payout of free cash flows as a central weakness of public corporations. Furthermore, he sees that the LBO governance model can help to overcome the central weaknesses of public corporations. He is convinced that the new LBO model, which was in his time quietly a new construct, how this LBO governance model helps overcoming the central weaknesses of public corporations, which results in higher efficiency, better employee productivity and shareholder value. And what is also really interesting, that many arguments which he named in this article have been validated through empirical studies on private equity afterwards. And this paper is also quite relevant right now, since we can see a trend towards private equity, since many companies are not pursuing the usual way of an IPO anymore. Only about 1% of all startups end in an IPO at the end of the day. In the late 1980s, this was about 20%. So we have a big change in IPO activity in the latest years. So let's have a look on the structure of public corporations. Well, you can see in the picture the structure, which is straightforward, and the most of you, I think, already have seen this structure. You got your board of directors, which is tied to the stockholders and debt holders. You have the CEO and corporate headquarter, like you have the whole C-level, which controls the different business units. And what he sees as a problem in the structure is that there is a dispersed public ownership and that there are managers without substantial equity shareholdings, which of course affects the interest alignment, since if the managers do not have substantial equity holdings in the company, maybe their interests are not aligned with the interests of their shareholders, which he identifies as a major problem, which also leads to most of the negative effects of public corporates. And he also criticizes that the board of directors is dominated by outsiders. So this was his main critic on the structure of public corporates, but he also mentioned some pro-arguments. One important pro-argument when it comes to public corporations is that the risk is diversified among much more shareholders than you would have in a private equity environment. In the private equity environment, we already learned that you do not have too many parties which are involved in. Often you just have one private equity company which takes over one company through an LBO, or maybe a consortium of up to 5 private equity companies or investors which are interested in the product, in the company. So there is a much higher risk diversification in public corporations, but he also says that there is still the principal agent conflict, since there is an interest conflict between risk bearers, the investors, and decision makers, the managers. And he also mentions that the public corporations have the problem that they have high monitoring costs for the individual, since every individual or every party which is invested in the company has to do the monitoring by himself. The total monitoring costs increase, and therefore the information asymmetry between shareholders and stockholders increases, which he also sees as a major problem, since the shareholders cannot or are not really following the company strategy, and therefore their commitment in regard to smart money, their commitment regarding also strategical input is missing, which he identifies as a major problem. When we go to our next slides, we can see like how theoretically the management should be controlled. There are theoretically 4 forces that should control management to act in the investor's interest. First of all, we got product markets, which is in particular competition. Due to competition, the management has to act in the best, in the interest of its shareholder, maximizing the value of the company to be competitive in the future. So product markets is one really important control mechanism of public corporations. Furthermore, we got internal control systems, for example, supervisory boards where more senior members are in the board, which are advising the company and also having influence on the checks and balances of the company. Furthermore, we got usual legal, political, or regulatory systems, just laws, some regulatory bindings or agreements which the management has to fulfill. However, they are set. There can be different structures how you can implement such a system. Can be in this working contract or also other incentive systems. And the last one are the capital markets, where the management is forced to act in the interest of its shareholders due to active investors that hold large equity or debt positions. They sit on the boards of directors, and they monitor and they dismiss management, and they are involved in long-term strategic direction. Well, this is actually, this leads us to one conclusion, that within high growth industries, there is usually not a big problem of the free cash flow issue, which was a big problem during Jensen's time, since during high growth times, there are more positive NPV investment opportunities than free cash flow is generated internally. If we have enough good investment opportunities, then the interests of both management and shareholders should be aligned. However, in low growth or declining sectors, managers often waste cash flow through organizational slack or investments in negative NPV projects, and not only investments into negative NPV projects, but also empire building or other reasons, which we will come to right now. There are several reasons why the management is wasting cash flow and not distributing it to its shareholders. But we will come to this in our next slide. So what is the free cash flow problem that Jensen is mentioning all the time? First of all, maybe we should define how we understand free cash flow. How we understand cash flow. Cash flow is the excess of debt required to fund all positive NPV projects. So every little bit of cash that is left is defined as cash flow, and he says that efficient and shareholder value maximizing companies must distribute free cash flow to its investors, for example, through dividends. But he also says that there are certain incentives of the management to retain cash. The most important one would be autonomy. If the management retains cash, he has more cash available in the future when he wants to implement some bigger projects, where he doesn't want to have the approval of the shareholders, and where he doesn't want to go through too many regulatory mechanisms. Therefore, he hurts the cash so that he can use it in the future. Another important thing could be like prominence or building of an empire, like making the company bigger than it should be, scaling it too big, which makes the company less efficient, but which could lead in more prominence for the management team, which could be in favor of their own interest, to be a more prominent player, a CEO that has managed even a company that was even bigger than it was when he started it. This can also be a reason, and also one of the most important reasons, just management income. If the management income, which is in most of the cases the case, if the management income is linked to company performance or revenue, then this can also be a reason to retain cash for the management. But we should also mention, which I also already did a couple of minutes ago, that the free cash flow problem was more a problem during the 1990s, where Jensen wrote the paper, and since then the buyout industry and also the public markets have evolved substantially, and most of the free cash flow issues are already much less a problem than they have been there. So we have been talking about the effects of free cash flow and how they are used or misused, but we should also talk about the effect of debt. And when we're talking about debt, most people would think that debt is not necessarily the best thing to have, except for leveraging your returns. But besides of leveraging your returns, debt has also disciplining effect. Through increased debt to equity ratios, you can first of all measure to solve the free cash flow problem. Like, you can see a ratio that signals that free cash flow has to be generated, and therefore you have legal obligations to meet periodic payments. So what you actually do is you are using debt, which is a legal obligation, to meet periodic payments instead of dividends, which you are free to give away, and therefore using debt instead of dividend payments is an effective instrument to discipline the management. And therefore managers are forced to skip negative NPV projects since they have to meet their legal obligation against the debt holders. Yeah, I think we got this through. And the solution or the summary of this could be that debt is used as an effective instrument, urging managers to choose the most efficient outcome for shareholders and overcome information asymmetry issues. Of course, through increasing debt, you can you urge managers in a way to choose the most efficient outcome. That's true, but overcoming information asymmetry issues is not always the case. I mean, at least you have interest alignment through debt, but information asymmetry issues will still arise if you do not monitor the company in the right way. And now we had the public corporation structure, and now it should be also important to have a look on the private, the leveraged buyout structure, which is a little bit different from the public corporation. First of all, you do not really have the supervisory board in the sense which is in the public corporations, but you have you are having a little bit different investment structure. What you are doing is that your partnership headquarters are investing into different leverage buyouts with the highest proportion in debt, which you can see is a bigger circle than the stock circle is, and a little bit of stock investment. So they have a high debt to equity ratio, and that's how their structure in general is. The private equity firm sponsors the transaction and afterwards monitors the management, and the company management in this case always holds substantial equity stakes on the buyout company. That's something really important which defines the LBO governance model, that the company has big incentives to increase shareholder value, since he is also a major shareholder to the company. And institutional investors, they fund the limited partnership, and thereby they provide the equity part of buyout transactions. So the institutional investors are they're taking care of the stock investment. The PE firms takes care that a bank gives a big debt position to this stock investment, and at the end of the day also the management gets a share of the investment. And what are the differences to public corporations in this when comparing LBOs and public corporates? Well, as I already mentioned many times today, management incentives are really strong, and there is a strong relationship between pay and performance. Therefore, we can see that there is an interest alignment, since the management wants to increase his own outcome, which he simply does through maximizing his shareholder value. And which is another advantage of private equity corporations, is that the private equity structure is more decentralized than public companies. This leads to the case that you have faster and better monitoring of the company. You can have a better overview of the company with all its financials and also strategic information. So you have a much better information distribution among the different parties. Another difference is that private equity relies heavily on leverage. I mean, not private equity in general, but maybe we should say that leverage buyouts rely heavily on leverage. Of course, you have also companies that are not highly leveraged. For example, when we are talking about green investment, which is a big topic from nowadays, those investments are tried to not be leveraged due to different reasons, and in such growth investments, let's say growth investments, you often see low leverage proportions, since there are risks higher, and when risks become higher, also the the debt lender doesn't want to buy too much of this risk. And another difference to public corporations is the LBO structure. It has well-defined obligations to the creditors and residual claimants. So even if you are working with mezzanine capital or senior debt bonds, all the seniority of all different debt instruments is well defined, and therefore the debt issuer also knows not exactly, but he can assess the risk of financial distress quite fairly, and therefore there's also an information improvement in the information distribution. So we can say that the incentive structure is used as a key driver for performance, which also of course attracts highly skilled managers, and this aligns interests with sharing stakeholders. So let's go to the next slide, which shows the main advantages of leveraged buyouts. There was a lot of text in the beginning, but I felt like maybe I will just have short 4 bullet points and I will talk a little bit about them. So first of all, you should keep in mind that management incentives, the decentralization, as I already mentioned, the high leverage and the well-defined obligations are the most important elements of the buyout structure. Management incentives can be summarized through the bonuses, which are closely tied to cash flow and debt repayment, then accounting earnings. Therefore, there are strong management incentives, and as well as already mentioned, the company managers hold substantial equity positions in the companies, therefore directly benefiting from an increase in shareholder value, which just is an instrument of interest alignment. The decentralization is the issue that indirectly you have compensation incentives are in place too. Substantial ownership allows direct monitoring of companies. As already mentioned, you have a better distribution of information, you have a high leverage ratio, and you have really well-defined obligations, since you also have binding agreements with debt and equity providers, which of course reduces the risk of unproductive reinvestments. Altogether, the LBO structure ensures active investors, institutional investors delegate the job of being an active investor to qualified professionals, in this example private equity managers, and private equity managers are aligned through own investments and their reputation, and being largely incentivized through performance-related compensation. So not only the private equity companies ourselves are incentivized through an ownership structure, but also the private equity investors themselves, since they have an equity contribution into the fund. They indirectly also have an investment into every single company of the portfolio. Therefore, we are using incentives, monetary pay performance incentives twice during private equity investments. So this was the part with a lot of bullet points. Now we will have some more pictures, hopefully. Now we'll talk about private equity firms as financial intermediaries, why are they relevant? Why can't a person, why can't we just everybody invest into private companies? And what is the advantage of having an intermediary? And could this intermediary maybe in the future be obsolete? So let's have a look first of all on transaction costs. I can see that this slide has a typo. It was supposed to show us the different transaction costs, but we can directly move to the next one because this one is quite easily showing what should have been in the first slide, that if everybody himself would have an investment into a private equity company, let's say you have the investors I1 to IN, which you can see on the left side, and you got the companies V1 to VM. You have, of course, several investments from each person on each company. So you have many transactions, which leads to high transaction costs depending on the transaction costs themselves, which are even more expensive in private investments. Of course, in public investments, it can be done really cheaply nowadays to invest into those companies, but in a private company environment, this is much more expensive. So through an intermediary, we are bundling all the potential investors which want to invest into different companies, and the intermediary itself invests into these companies with the according proportion which is defined by its investors. So we have in total much less transactions, and therefore we are increasing the efficiency from the transaction point of view. But it is not only that the total number of transaction is reduced, but it is also several other reasons why a private equity company is an efficient intermediary. Okay, I mean, saying efficient, there is never really an efficient intermediary. The best thing would be an efficient market, but since we know there's an efficient market is a little bit futuristic and not really possible today, I think an intermediary in private equity transaction is really important because, I mean, we can go through these points which mainly summarize the reasons for that. We have the initiations cost. I mean, private equity companies, they are used to evaluate investment opportunities, therefore they know what's going on in the market, and therefore they can value in possible investments much faster than the investor maybe could make himself, since the investor wants to invest in a large portfolio of companies. He maybe is not able to evaluate all these companies as good as an intermediary, as a private equity company could. Another big thing which leads to transaction costs are the information costs. The private equity investors are mainly specialized into different segments, and therefore they can they know the market really well, and they do not have to do too much research on the market to evaluate the companies. Again, this is initiation costs, and information costs is also something that has to do with the knowledge of the private equity investor, as well as the control costs. The control costs are standardized costs, which can be also bundled in the accounting and controlling divisions of private equity companies. So therefore, you are reducing the overhead also through the bundling of different investments into one professional. And then you have costs that are always the same, but which can reduce through standardization, which private equity, in this case private equity companies, can monetize their knowledge from previous transactions by reducing contracting costs, adjusting costs, and executing costs. Just having already gone through the learning curve on these points gives them an information advantage, which also leads to much lower transaction costs than individual investments. Now we should maybe talk about minimum investment volumes. Well, we have first of all a required size of investments, and often this exceeds financing possibilities of a single investor. So therefore, bundling the financial capabilities in a fund can lead to investments which you wouldn't be able to do by your own. If there is a nice investment which I could realize for 200 million, but my own possible equity contribution would only be 20, I most probably couldn't do this investment. But through investing into a private equity fund, I could add the funds of also other investors, and we could do the investment together, and I could profit from the growth of this specific company. And therefore, private equity firms have a transformational function as an intermediary which bundles the funds of his investors. And in this way, also smaller contributions from investors are possible, which makes private equity more accessible also for the public. Since if there wouldn't be an intermediary, you would have to have the investment volume by your own, but through having a private equity company, and there are getting more and more private equity players are arriving at the market, you can all find smaller fund sizes with time, since we have more private equity companies in total. So opening up the private equity class for an investment is done by private equity firms, and also this leads to the possibility to enhance investors' asset allocation. If you want to further diversify your portfolio, then private equity is a good possibility, since private markets are less tied to the beta factors of public markets. Therefore, you can use private equity to maybe not to hedge your public positions, but to further diversify them, since hedging in this environment is quite hard, but through the investments into the right segments, of course, you can also do a little bit of hedging. Okay, so maybe we should summarize the pros and cons of private equity investments in total. The pro side that you have also means to increase diversification in private equity. Now, this is a little bit abstract, but if you think of a private equity investment as an investment with the biggest proportion of debt. So let's say you have 30% equity, 70% debt on a 400 million, 100 million transaction. So 70 million of this transaction is financed through debt, and the debt is financed through public investments into banks. So indirectly, through your private equity investments, you are diversifying the risk to more parties, which is a little bit abstract, but which is really important, especially in the times where we are right now. In the times where many companies are filing for bankruptcy, where liquidity problems becomes even more problematic than before. In these days, this argument is really important, because at the end of the day, if the big debt positions of private equity companies cannot be paid by the companies themselves due to the crisis. At the end of the day, the normal guy who gives his money to the bank will pay its price for that. So this is a really important argument which you should keep in mind. Then another pro argument is the outperformance of private equity companies. They have outperformance most ETFs by more than 10%, but we will come to the fund performance of private equity firms next week. And another pro argument is the high degree of private equity funds involvement in the portfolio companies. Nowadays, also as I mentioned last time, companies are seeking smart money. They want an investor which also has some strategic input, which adds value to the company. So therefore, having a private equity company which has knowledge in a specific segment is something that founders really are seeking, and therefore also founders are taking discounts on their company. So I have also seen companies who did take a smaller offer from investors with the argument that they thought that these investors could add more value to them, and they thought that the value increasement that this company that this private equity company brings with him is more valuable than the extra cash that they would get from another investor. So this is also a really important point, which is why private equity companies also perform that well nowadays. Big counterpoint is the high volatility. We have seen last times the probability distribution of private equity returns, and we saw that depending on risk diversification in terms of whether you are doing a single investment, you're doing private equity or funds of funds investment, you have more or less volatility, which is of course also tied to more returns. So therefore, seeing this as a big counter argument has to be relativized, since you also have to see the high return potential. Another big contrapoint, which is really important, are the management costs. If you look to gross and net returns of private equity proceeds, then you'll see a big difference. But we'll also come to fees next week, where this is a big point, that management costs are a big proportion of the overall proceeds. Then you have a lack of liquidity, the J curve, during the first initial investment period of 2 to 3 years. You most usually don't get any proceeds from the fund, since investments are made, and these investments have to first of all lead to revenues before you can get any cash out. So you are lacking of liquidity during this time. You need really considerable amount of capital. I'm not sure what the lower bound for an investment into private equity companies is. I know that according to ESG policies, there is something like that you can invest starting with volumes from 50,000 euro. So if you have 50,000 euro, most funds which are conform with the ESG policy will theoretically allow you to invest, but at the end of the day, most private equity funds won't accept you, since they're saying, man, you're just making 0.1% of my funding target. I don't want to spend my time with you. I would rather take some other investors which are funding volumes of 10 or 20 plus $1 million. So therefore, theoretically, you are You can invest into most private equity companies which follow ESG policies starting with 50,000, but at the end of the day, you won't meet any private equity companies which will allow this. Another counterpoint is the required expertise you need as a portfolio company manager, and also as an investor. You need a lot of expertise with this segment. You have to understand how the cash flows are tied to each other, how the incentives are built around you, to fully monetize your environment. So it requires quite a bit of expertise, which is why young startups with young professionals most often sell the company much earlier than more senior teams would do, since those younger professionals, they are lacking the experience, and therefore many of them are saying to themselves on this stage, I would like to exit, but with my second company maybe I will go further, since I now have the experience and I will do things different than I did last time. Also, we should mention that the access to the best funds is really hard. For example, the KKR funds or the Blackstone funds are funds that are really popular among potential investors, and therefore also the competition among potential investors is quite high, which leads to oversubscription of these funds. These funds often have subscriptions of more than 20% of what they are investing in the end of the day, which leads also to a big difference between net and gross performance, since also the not used subscriptions are used to calculate management fees. And the other big counterpoint is that you are investing into a blind pool. You do not know into which companies your private equity fund investment will go into. You just know the strategy of the you just know the private equity strategy, you know the geography, you know the industries which the fund is gonna invest, but you don't know the companies themselves. So therefore, having a blind pool investing is also something which can be particularly a problem when you have private equity companies which are not too long in the market. So that's the last chapter for today. Before going to the last chapter, I will check whether there are any questions. As long as I can see, there are no questions. I think Simon is also answering most of your questions quite well, if there are any. If not, of course, you can always also write a short email and state your question. You will see the contact details at the end of the presentation. But let's go on with the fund lifecycle and fundraising, which is also a big deal. We saw the investment cycle last time, where we saw that private equity companies have an investor and a portfolio company view. And from an investor's perspective, there are just 3 parts of an investment cycle. I mean, with the overlap of the private equity, they have the fundraising, and after they invest into a private equity company, there are the investor relationship, where they get all the monitoring of the companies, and at the end of the day, they get the distributions from the investments. So looking at the fundraising is quite interesting to have a feeling for what is important for an investor to invest into private equity companies. The fundraising process is mainly divided into pre-marketing and due diligence of the fund, the structuring of the fund, and the closing. We will have a little deep dive on all of these 4 points right now. In the pre-marketing, you mainly have informal announcements and talks with potential investors. You are teasing your fund to potential investors by pitching the main idea, where you want to invest, how your management team is. For this, there is a standardized marketing material, which is called an information memorandum. Maybe you have already heard of something like that. This is quite common in private equity, but in mergers and acquisitions in general, you get an information memorandum, which contains information about the target market of the fund, the investment strategy. Is it going to be buy and build? Is it going to be growth capital, or leverage buyouts? What is the strategy? And also the information memorandum contains information about the composition and reputation of the investment team, which is really one of the most important factors for investors. When investors want to invest into a private equity firm, two things are the most important ones, and this is management team and track record. So what is the academic background and professional background of the management team? Is the management team proven to be profitable through their track record? And without having any track record, it is quite hard to get in the right fundraising process. So think about, let's say, two ex-McKinsey consultants who want to open a private equity fund, for example. For them, it could be a little bit problematic to get into the fundraising process, since investors can see, okay, these guys have they have the experience in the consulting industry, but I think they maybe think that the management is good of the private equity company, but without seeing any track record, it is still hard to believe them. What startup private equity companies do in those cases is that they are trying to raise money on a per deal basis. So they are simply doing co-investments with investors on each deal until they get a track record. So in this way, the risk for the investor is much lower, because he already knows in which company the fund is going to invest in, and in this way also the newly formed private equity startup can gain his track record. So we talk about pre-marketing with information memorandum. Let's go into due diligence, which is also a really important factor when it comes to evaluating a private equity company. Their investors require detailed documents from the private equity company, financials, financial reports, also distribution schemes, how is the structure of the proceeds, how are they distributed among all stakeholders, which is really important. Also, there are going to be personal meetings between the PEs and individual investors to have a look also on the personal fit, which is sometimes also really important to certain investors. And in this due diligence, the investors mainly analyze whether the performance which has been told to them is legit, and whether private equity companies did some financial engineering maybe to increase the performance. Now we have talked about the due diligence, and let's go to structuring. When we are through the pre-marketing, we got the information memorandum, said, okay, this private equity seems to be cool. Let's have a deeper look inside. We had the due diligence, where we had a look on the numbers of the private equity firm, and we said, okay, this looks good. They have a good track record. They are profitable, and we like the return and the investment strategy. Then you are going to go into the structuring. And the structuring, you will mainly finalize the limited partnership agreement, which is going to be a legal document where compensation structure, the distribution scheme of costs and profits is discussed, and also many convenience relating to the overall fund management, to activities of the general partners, restriction to the type of investment. So in this convenience you can find anything. Most of them are standardized convenience to the private equity companies, but you can always find some special convenience. I don't know, like for example, if you have an institutional investor who says he only wants to do green investments, or let's say, which is something really interesting, is Islamic finance, where you have funds which do want you to have some specific Islamic convenience. If you have such an investor on board, of course, you will also have some really exotic convenience that you wouldn't have with other investors. But let's be honest, sometimes cash is cash, and therefore you are willing to take some convenience if they are not disturbing your investment strategies. Therefore, if those interests can be aligned, you can also find several different kind of sponsors. And that's actually also the last slide for today. The fundraising closing, at the end of the day, mostly you do fundraising for about 1 year. You can have your first closing if you already collected like I would say like 50 or 30% of the money that you wanted to collect. You can have a first closing where you can start investing into companies, and a couple of months later the second and the final closing takes place. Sometimes private equity companies only do a final closing. They don't have a first and second closing. It depends how well the fundraising process was overall. Of course, if you didn't reach your goal in the first closing, you want to make sure you have a second closing to also get some other investors on board. Therefore, also, since you have a first and a second closing, it is not always easy to determine the vintage year. The vintage year is the year in which the private equity portfolio starts to invest. It is a quite important metric since it gives you information about the environment during which the fund invested. For example, having private equity funds with a vintage year of 2006, for example, you could expect that the average return is going to be much lower than a private equity company with a vintage year in 2012, because you have the financial crisis in between the first in the first vintage year. Okay, this is it on my part. I'm not sure you can see our contacts from me, myself, Hassan, and Simon. Are there any questions left, Simon? Oh, I can see there is one. I'm glad that you asked the question, honestly, because having a webinar is kind of cool, but there is a missing discussion, which I like to do, and therefore maybe also the presentation is a little bit like a long monologue. I hope that you can follow at least what I'm talking, and it's not too boring. Okay. The question is, how can investors conduct a detailed due diligence if they don't even know which companies will be bought out? Well, they don't do the due diligence on specific companies. What they do a due diligence on the private equity company. So they are having a look on the management team and also their background, professional background, and they are on individual track record, and afterwards they will also have a look on the track record of the company itself, and they want to evaluate all of this. And with regard to track record and management background, they will also have a look on the investment strategy. So you maybe cannot have a due diligence on the company that the PE fund is going to invest, but you can have a due diligence on the industry, or on the industry mixed with the geography the fund wants to invest in. For example, you as an investor elaborated that life science investments are gonna have a high internal rate of return in the next years. So you are saying, okay, I want to have private equity investors who are in the life science, who are investing in the life science business. So you are having a due diligence on every information that you can have pre-investment. Of course, post-investment due diligence is not possible when you do not have the company. I hope that this question is answered. You can give a short feedback to Simon. He will reach out to me whether the question is answered well enough. Oh yes, since I've mentioned blind pool investing before. Are there any other questions? Okay. Also thanks on my side. Okay, so this will be from our point of view. Thanks for your attention. I hope to see you next week. Next week is gonna be really interesting. I can maybe jump to the first slide where we can see what we will have next week. We'll talk about fee components, how are private equity companies making money. We will talk about the performance of private equity, and also talk about how you can measure them, and also have a look on historical performance, so you will get a feeling for how much money you can make in private equity and how this money is distributed. Feel free to also share the next webinar with your friends and colleagues. We would be happy to also see you next week. So this was it from my side. I wish you a good evening and see you next week.